Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about lower mortgage rates and what we should expect now from any Fed rate cuts. Logan, welcome back to the podcast on this day.
First of all, it's football season. That's the most important thing. Second of all, I joined the HousingWire Fantasy Football League, which I never play more than one league, just to beat you. And third of all, for everybody who's listening who's a fantasy football fan, both my drafts were number one. So I had Christian McCaffrey. The one guy I was playing already scored the league high. I was going to lose, but picked up Mason. I'm a Niners fan. I was so happy. End up winning by half a point on that last run he had to the sidelines. I have so much energy and juice just because the Niners whooped the Jets, and it's just been a really great week. And we almost have sub 6% mortgage rates, Sarah Wheeler.
This is the part we're going to talk about.
The spreads, baby, the spreads. I mean, everybody is in shock and awe on how good the spreads. This is Wednesday morning as we're talking about it. We're almost getting close to the 2024 low-end forecast of 5.75. But again, any human being that can read and write and can visually see can do a forecast. I always ask people for the forecast. I don't get many, but it's the why factors that matter. So what takes it up, what takes it down? Softer labor data, paper, rock, scissors, labor over inflation. We'll go in that a little bit later. But also the spreads are getting better. And the contention was always with the other side that said the spreads could get really bad because of the 1970s again. And then, so it's a good day. It's a good day.
It's a good day. It is a good day. We've been waiting for this day. We've been waiting for this day for what, like a year and a half, 2 years, whatever, to get below 6% is huge.
Yeah. And again, it's one of the things, and the reason this podcast is being done in this way is that we're already seeing a lot of bad takes out there on lower mortgage rates haven't helped. That's not true. And Sarah, you and I have talked about this for 4 years. I do not believe people are trained to read the purchase application data. And once again, I'm seeing it again. And I'm not talking, listen, the doomers are always going to hate everything. Who cares? But there are some really smart people that are making this mistake. So we're going to first start by saying that the new home sales market has their own purchase application data, and it already grew. The forward-looking data on the confidence for the smaller builders started to get better 2 months ago, and we just had a massive beat in new home sales, which matters to the economy more, which I think the Fed cares more about the new home sales market than the existing home sales market. It all already happened, and I got people out there, lower mortgage rates aren't doing it. What? Rookie ball. We can only teach you guys so much. You guys have to walk the path where we teach you. So it's already impacted the new home sales market via a sales report and forward-looking data. But also, purchase application data came out today. Remember, purchase application data is a very seasonal data line. Second week of January, first week of May, volumes fall after May. Now, what happened the last 2 years is that mortgage rates fell over 1% in November, December, January. That's close enough for the seasonal demand curve. Here, we actually have the best 14 weeks of the year because the year was actually quite negative. And 9 positive purchase apps, 5 negative. And it's like people are like, it's not doing anything. So we can teach you guys so much, but you're going to have to walk the path on it, right? So there's actually a noticeable change with lower mortgage rates. A lot of this has to be that the year was quite negative. End of 2023, mortgage rates went from 8.03% down to 6.63%. We only had 8 weeks of positive data on that. We had those 2 really big sale prints in the seasonal curve. And then that was it. We even wrote that article in March saying that's probably the peak unless rates go down. So we're seeing a positive movement with lower mortgage rates. I think people are just caught off guard on how to talk about housing in a more methodical way and don't know what to say right now because they don't understand the seasonality of some of these data lines. But the new home sales is already improved enough to get everyone's attention. And also now the existing home sales went from a negative data line now to a positive.
And we've been talking about how that sub 6% world is what the new home sales have been operating in, all year. And we've seen they have demand at that price or at that cost. And now we hope to see that right in the existing home sales.
So this goes into a really interesting topic. A lot, I hear this a lot. Why doesn't the Federal Reserve ever say anything about housing? They don't care. The existing home sales market, they just don't care. I mean, look at the statements. Neil Kashkari had a panic attack last year when mortgage rates got to 6%. Oh, we can't balance the economy. The inflation is, Bowman said, we don't calculate the housing market in our, what? And it's like, new home sales, yes, you do, right? That's how cycles work. Even Powell said, the housing market is subdued. No, homie, it's the third calendar year of the lowest home sales ever. Come on, it's not subdued. So I think what the best way to explain this is that in the previous decade, I never thought the total home sales data could get over 6.2 million until our demographics got better. So that actually will stay true. But the Federal Reserve almost looks at housing as like, okay, we have near 5 million total home sales. In the last decade, the peak was near 6 million. So we're missing 1 million home buyers, and they don't see it as like a very problematic thing right now. In 2008, everybody was zero interest rate policy, QE, everything they can to try to stimulate housing. But back then, much different marketplace. Demographics were worse. Credit markets were busted. Underwater homes. You had a lot of things keeping demand. So for them, they're just not into the existing home sales market. I understand. I get it. It's like we're at the point where the government's trying to step in and create more demand. But you have to think of it. The new home sales market actually matters to the economy in terms of construction, job, labor. And we always talk about this. From March of this year to July, there was no growth in residential construction workers. We had one negative print, actually. Okay, we were highlighting this, that this is the time where it actually looks like every end of economic cycle work. Permits were falling, starts were falling, and remodeling companies were warning. So this is actually material. If the Fed are actually true data people, this is data that actually matters. So the fact that I think new home sales started to act better, they're pretty much happy with that, while you don't see any comments, even today, about the existing home sales marketplace. So it is what it is, but definitely we have seen a change since mortgage rates started to fall, both in purchase application data. We saw it in the new home sales data. Now purchase apps look out 30 to 90 days, right? So it's a distance forward looking data line. So I would say that this data line shows that it is stabilized and the negative trend that we had is now positive. Then we have to see what happens in the seasonal time frame, right? And that's why it becomes interesting if we could get the sub 6% world, because the builders, if you look at their purchase application data, it's way up from the lows of 2022, right? So that it's not even a competition. They're outperforming, but they could work in a 4 to 6% mortgage market world where the existing home sale has never been in that atmosphere at all whatsoever. So it gets just a lot more interesting. And we are literally almost at the low point of the forecast for 2024 now.
Okay, so let's talk about a couple of things, because you've mentioned mortgage spreads several times in the last couple months about how this year mortgage spreads are so much better than last year. And if we had the same mortgage spreads of last year, this year, I mean, we'd be up like at different points, 0.5%. It's been pretty remarkable. How does that factor in now?
So as of this morning, we just did a quick calculation on a live data. It's like an 80 basis points difference as of this morning to the peak. So this is real. Like, this is real. I'm very sympathetic to the people that said mortgage spreads can get worse in a recession. Okay, that there is some historic validity to that, but we are working from an elevated level. And because we've worked from an elevated level, the trend is down usually, especially when the Fed starts its rate cut process. So we've seen that first move already. But if I took today, boy, it's like an 80 basis points difference. These are now becoming material things. And like many months ago, we said the spreads are going to get better, good enough that you don't need the 10-year yield to get to the Gandalf line at 3.37 to get, right at 6% mortgage rates. We are here at 3.66 today, and we're close to 6%. There are people getting mortgage quotes now sub 6% today. So all of this is a positive. It's like I'm seeing there, like I'm watching social media, everybody's like, no, nothing. I was like, what are you people looking at? And I just think it's very difficult for people to read the purchase application data unless you're trained to read housing data methodically. And you gotta, what do we say? We Fight Club rules. We separate the new home sales sector and the existing home sales market.
Right.
But I've realized that people just don't know that the new home sales sector has their own purchase apps, and they're thinking the existing is new. And I was like, what? And again, experience. This is where experience kicks in. This is where forecasting and people who actually do this for a living versus the orc armies out there and their terrible YouTube pages.
Okay, so we're having all of this happen the week before the Fed meeting. Don't they meet next week, right? In which we've been talking about like, oh my gosh. So if you're sitting out there and you're like, okay, this is where rates are today, getting close to sub 6%. If they cut next week, that means we're going down even more. So please tell us why that doesn't work that way.
Wheeler, no. Fed rate cuts are not the story. It is old. The bond market does not wait for the Federal Reserve. They are not old and slow. So the only thing that can really push right now is that the spreads get better. Okay. So people think that, well, if the Fed cuts rates, mortgage rate, to me, if you wanted to get a positive forward moving in the bond market, the Fed says, we cut 50 and we are going to go full blown to make bond yields go down and mortgage rates go down to help the housing market. If they said something like that, but we've had a 2% move already, zero, no cuts. And this is how cycles work. The long end gets ahead of the short end. The 2-year yield now is really pricing at a lot of rate cuts already. So the Fed is playing catch up. So it's already kind of happened. This is why I said 5.75 is like the lowest I can go. If we had like an authentic job loss recession, if we had like hundreds of thousands of jobs being lost, then we get to that 3.21 level on the 10-year yield. And if that breaks, because we are in a recession, then you go to that 2.7. That's all job loss recession at that point. So what happens in the Fed right now, people are pricing at a quarter, but hypothetically, let's just say they did a 50 and were super dovish on their statements. That can make a difference, but we've already had the move. If people think, well, if they cut rates, we're going to have another 50 mortgage rates. No, the economic data led this to this level. And I think that's where some of the confusion has been, but the long end typically gets ahead of the short end. The short end typically gets ahead of the Fed rate cuts. And if you look at the 2-year yield and the 10-year yield from where they were at the peak of 2023, if you didn't know that the Fed didn't cut rates, you're assuming the Fed cut rates 6 to 8 times already. If you just look at that, oh my God, this is a nerd chart homework. Go look at the 2-year yield and 10-year yield and assume that you just woke up out of coma. If you didn't know this, you probably think, oh, the Fed must have cut 6 to 8 times already. No, they haven't. They've zero. Market gets ahead of the Fed. Markets are not old and slow. The Federal Reserve is old and slow just by the nature of the beast. And thankfully, the bond market is helping America try to stay out of this recession while the Fed goes, we need confidence. They went from we need confidence to the labor market is strong to we're talking to people on the phone and they're telling us they're slowing down, but they're not firing people. So
yes. Okay. So see, I think this is a really good point because you've got real estate agents out there, loan officers out there. They're talking to their customers and their customers are like, if they're paying attention, they could be like, wow, this is great. Rates are going down. Are they going to go down even more next week? And from your perspective, it's like, that's not the factor we should be looking at.
Nope. It already happened. The big move. I mean, like I said, there was a reason why I kept that 5.75 as kind of the low end limit. Think about what you would need right now. You need weaker economic data. So let's just give you, today we had inflation, CPI inflation day. The headline year over year is 2.5%. Oh my God, Arthur Burns. It's the 1970s again. Oh, some of you men. Oh, in any case, the 10-year yield spiked up right after that because the month-to-month core print was a little bit hot because of the crazy way we track rent inflation. But 10-year yield spiked, went up 6-7 basis points. Then the stock market sold off, and we talked about that in the tracker recently, that this is the time where if the market sells off, money can go in the bond markets, and yields came down, then it spiked up again. The bond market is like, whoa, what do we do now? What do we do now? And that's correct, right? It was able to break that 380 because the labor data, jobs week at 3 of the 4 reports were more negative than the estimates. But now to get the next leg lower, for mortgage rates, you need better spreads. For the 10-year yield and mortgage rates, you need the Fed to sound dovish, not this, we believe a 0.25% rate cut is warranted. We are going to do what we can to make sure that our dual mandate is being processed.
That's like Robot Logan.
Yes.
That's like a Robot Logan
yes, it
voice.
Is. Yes, it is. I am a robot stiff of Jay Powell, and I talk to my 12 members, and they tell me what to say. Okay, so it's like the bond market's like, homie, we're already gone. See ya. Okay, the 2-year yield's down here. So that's why I always say, this is why the last 18 months we talked about the bond market isn't old and sold. They will get ahead. So verbiage is key, but again, so much of the move is already done because why? The Fed is still very restrictive. I mean, literally, if you woke up in the morning, you saw where the 10-year yield's at and the 2-year yield, you think the Fed has cut 6 or 8 times, and zero. Not a Wheeler. Zero. It's like Aaron Rodgers trying to beat the Niners the last few years. Zero.
Okay, so, and this is also a really good point to say that if our listeners are readers of the tracker, they already knew this information. I mean, they didn't know exactly when it was going to happen, but on Saturday, the headline there is like, can mortgage rates go lower? And you outlined the 3 things, or I can't even remember how many things, the things that had to happen for mortgage rates to go lower. And that's what happened this week.
So the tracker is designed because we believe it's the most prolific current and forward-looking housing data line out there, because what Mike Simonson does is he's the king of inventory, and I incorporate my economic models to my housing economic model work, right? You put those together. Is there anybody else on planet Earth? Anyone? Please bring them. Let's debate everyone. But it is designed to functionally tell you, because, like, for example, let me give you a good example of this. Early on, like after March, we talked about price growth data should slow down. The year-over-year data was showing 5, 6, 7% year-over-year home price growth. They said the comps were really low, but because inventory had been growing, the price cut percentage has been growing, it's going to slow down eventually. We're going to get that slowdown in price growth. But now we're starting to see that, whoa, inventory has not been able to hit my targets, which makes sense. My targets were based on mortgage rates being above 7.25%. Now we've had back-to-back declines in inventory. Nothing spectacular or anything like this, but we want to look out forward because we need to react to a marketplace that is near 6%, not 7.5%. And if you don't have any working models, you do what most people do on Twitter, YouTube, and TikTok, and Instagram. Just make stuff up, throw it up in the air, and hope it sticks. That's what they do. None of them have any working models. I beg you, ask them for it. Ask them for their tracker. Ask them for their forecast. You will get zero, nothing, right? So follow the data and then incorporate a model. Okay, no, none of you people should be incorporating models because that's not what you do. But let us do our thing. And if the data changed negative, we'll go negative. It's just positive. But there are things that are changing right now. And I'm just seeing people going, what do I do? Oh, you don't have the data. We do.
We do have the data. Okay, so you put the housing industry in a recession. You put housing in a recession in 2022. What do these low rates mean for housing coming out of a recession? How long do they have to stay? What does it look like?
We separate the new and existing. June 16th, it was actually June 16th, not June 5th. June 16th, 2022, 5:31 p.m. The existing home sales market is going into recession, right? That's when we're about to see the big collapse in home sales. Transfer of commissions, right? Real estate agents loan officers, escrow people make their incomes are based on transactions. So that's still in a recession. That doesn't, you would need sales to grow, like grow for some time to get out of that, right? The new home sales on another factor after November 9th, which is the key, November 9th, 2022, for those who have followed us, the housing and economy structure actually changed after November 9th. They took everyone. Oh, it's awesome to see the Wall Street, like hired PR economists, go into a recession call in 2023 and absolutely completely whiff, because the builders' confidence index changed. So permits started to rise. Now permits have been falling, starts have been falling. Does the HMI data and the things actually start to kick permits back up again, and we start to grow housing starts? See, right now we're at risk of having both housing sectors in a recession, because housing starts in a recession, permits are in a recession. Oh, we're going to build millions of homes. It's like funny. I see this. What is it? Presidential. We're housing shortage. Housing starts at recession lows. How does that work? We need billions of homes. We're out of recessions. You need demand for these people to go. So lower rates. It is a function of demand to build, guys, right? This is why I would say the Federal Reserve has stayed way too tight for so long that the production of future supply is going to get hit. And look, we're here. Everyone's screaming, we need millions of homes, and housing starts at a recession levels and permits are, right? If I was an alien coming from outer space and I say, you guys really want to build it doesn't look like that in the data. So lower rates can grow new home sales, and hopefully that grows permits again. I don't know what's about the multifamily sector, but single family permits, you could get that and push it along and maybe get housing starts growing back up again. But the existing home sales market needs sales to grow and stick. It can't do these 1 or 2 months of sales booming and then rates go up again. That's why I would say you need 2% plus lower rates and stay there. Simple model, 6 to 8% back then. Right now, you get 4 to 6, and it does not go above 6. It sits there. That's how the previous few decades have worked. That's why the 1980s, early 1980s, we had worse affordability, a recession, all this stuff. But home sales started to perk up again because it's working off a low base, but it had 2.5% plus lower mortgage rates, and it's stuck there. We don't have the ability to have like 19 to 17% mortgage rates come down lower in a significant way. But you can get something to where if you wanted to grow, right? There it is. That until I see otherwise, I just can't see the existing home sales market growing at a 6 to 8% level consistently. But a 4 to 6% level, history has shown us you can grow sales from these very, very depressed levels. So, it's exciting. Wheeler, it's football, it's this. I still haven't got a forecast for my housing pricing crash friends. It's almost getting into October. Candy shopping, it's great. We're pumped. And the Nerd Tour is going off too. So
many exciting things happening. Also, going back briefly to the fantasy football, I had a terrible draft. I think they rated me a D on my draft.
What did they say? They say Chart Daddy A+. Chart Daddy can do drafts too.
Yeah, not surprising since you are, the data guy. Anyway, we'll see how that works out after a couple more weeks. But excited to have you on. Thank you for being on, explaining all these things to us. And I love having, a podcast where we're talking about rates going lower. That's so good for everybody.
Yeah. It already happened, but it's good. Let's debate if mortgage rates can go even lower from here. That's a good point. But the fact that they've already made the big move already, and hopefully now in 2024 in September, people realize all this time the bond market will get ahead. It will not sit there. Could you imagine if the bond market was as slow as Kashkari and Bowman and all these people, and they go, we believe for reacceleration, the 1970s inflation. And could you imagine? We would completely, no, it would be terrible. But now you're basically guaranteeing a recession, but that's not how the bond market works, because bond traders want to make money and they get ahead of the curve. And thankfully, if everything stays constant, the 2-year yield is telling the Fed that you're really behind the curve. So the question is, what does the Fed say about that? This Federal Reserve, until proven otherwise, has said they will be slow on this. They'll say 0.25%. So it is going to be more interesting, the verbiage of next, because you could have a situation to where they get a quarter and they say something hawkish, and then the 10-year yield goes up, that could make sense because, again, when the labor market breaks, the Fed's done, right? They can't control anything. Everything it would just splat like a million pies being thrown at their faces at that point. You can't do anything. But labor data getting softer has gotten their attention. But the bond market, again, got ahead of every Fed member out there.
All right, Logan, thank you so much for being on. We will talk to you again in a few days.
Pleasure, Wheeler, and I cannot wait to beat you in fantasy football.
Well, that's still not certain, Logan. I'm going to be fighting tooth and nail.
That's true. You could have the worst draft and the worst team, and somehow there are weeks that the worst team wins. It just happens. That's just the way fantasy football is. So yeah, you are absolutely right. There is a chance for you winning.
If anyone out there is a fantasy football expert, I need you on my side. Reach
oh
out.
Yeah, okay. you better start asking for help. That's a smart move, Wheeler. There you go.
All right, talk to you soon. Bye.